The banks just smashed silver at $85, and they want you to panic. They want you to believe this is the top. They want you to believe the bull market is over, and you should sell before it collapses further. They are lying to you. And not just a little lie. This is a calculated algorithmic attack that borders on financial crime scene manipulation, designed to steal physical metal from your hands at the exact moment scarcity becomes irreversible. Last Tuesday, silver hit $85.16 per ounce, the highest price in 44 years. And then, within 72 hours, the paper price was demolished by 11.3%. Look at the chart on your screen. That vertical red candle, that's not market forces. That's not profit taking. That's $14 billion in coordinated short positions opened by 4 major bullion banks between 2 a.m. and 6 a.m. Eastern Time, when retail traders were asleep. Here's what they're not telling you. While paper silver was being destroyed on the COMEX, physical premiums at coin dealers exploded to $9 over spot, $9. That's a 14% premium for actual metal you can hold. The disconnect between paper price and physical reality just became a chasm you could drive a truck through. If you are watching this and you sold during that dump, you did exactly what they wanted. You transferred real metal to institutions who are stockpiling for what's coming next. And what's coming next is a supply crisis so severe that $85 will look like the bargain of the century. The commercial short position data released Friday shows something stunning. Net short positions increased by 89 million ounces during the crash. 89 million ounces. They're not covering. They're doubling down on paper manipulation, while physical inventories at the COMEX dropped another 2.1 million ounces in the same week. But here's the critical data point they buried on page 17 of the CME delivery report. Eligible silver, the metal actually available for delivery, now sits at 47 million ounces. That's enough to cover exactly 1.3 days of global industrial demand, not investment demand, just the factories. 1.3 days. Wait until you see the industrial demand numbers I'm about to reveal. What I'm about to show you will detonate everything you thought you knew about silver supply dynamics and why this smash was actually the final warning shot before the physical market breaks completely. To understand why this is an extinction-level event for paper silver, you need to understand what changed in the physical world while traders watched price charts. Solar panel manufacturing just crossed a critical threshold. In 2025, photovoltaic production consumed 389 million ounces of silver. This year, 2026, the International Energy Agency projects that number hits 527 million ounces. That's a 35% year-over-year increase in one category, in 1 year. But solar is just lane one. Electric vehicles now require 0.85 ounces per car, up from 0.64 ounces 3 years ago. Why? Battery dendrites. Those tiny metal whiskers that form in lithium-ion batteries and cause fires. Silver coating stops them cold. Tesla's new 4680 battery cells use 18% more silver per kilowatt hour than previous generation cells. Ford just confirmed their 2027 EV lineup will standardize silver-coated cathodes across all models. Global EV production for 2026 is tracking toward 23 million units. Do the math. 23 million times 0.85 ounces equals 19.55 million ounces just for cars. And that number doubles by 2028 based on current factory construction. Now layer in 5G infrastructure. Each 5G base station requires 1.2 pounds of silver. That's 14.4 ounces per installation. China is building 40,000 new stations per month. The United States is finally accelerating deployment with 87,000 planned installations this year. Europe adding another 112,000 towers. That's military-grade silver demand for telecommunications infrastructure that didn't exist 5 years ago. Here's what Wall Street doesn't want you to know. We just crossed the line where industrial consumption alone exceeds total mine production. Global silver mines produced 824 million ounces in 2025. Industrial demand in 2026, 943 million ounces. That's a deficit of 119 million ounces before a single retail investor buys a coin, before a single institution adds to reserves, before any investment demand whatsoever. The last time industrial demand exceeded supply was palladium in 2017. Palladium went from $490 to $3,000 in 31 months. But palladium had substitutes. Silver has none for most applications. You cannot make a solar panel without silver. You cannot make a 5G antenna without silver. You cannot coat EV battery components with copper or aluminum. The physics doesn't work. Banks are playing a paper game. Physics is playing by periodic table rules. Physics always wins. The technical white papers from MIT and Stanford both confirm silver's unique properties: highest electrical conductivity, highest thermal conductivity, most reflective metal on Earth, make it irreplaceable in high-efficiency applications. When efficiency matters, when you need maximum energy conversion, silver is the only option chemistry provides. And every month, $3.2 billion in paper silver derivatives trade on global exchanges. Meanwhile, actual physical silver production, $1.4 billion per month. There's more than twice as much paper silver trading than physical silver existing. That's the house of cards they just defended at $85. And guess who was positioned for this exact moment? The names I'm about to reveal will shock you. Samsung, Toyota, and sovereign wealth funds from 3 nations were buying the physical dip while retail panicked. This is where the real money is moving. Let me show you the extinction equation that proves this ends in a violent repricing event. Start with mine production, 824 million ounces. Now subtract industrial demand, 943 million ounces. You're already negative 119 million ounces. But wait, the equation gets brutal from here. Government demand. India's central bank announced they're allocating 4% of reserves to silver. That's 48 million ounces over 18 months. They've already purchased 11 million. The Russian central bank added 6.2 million ounces in Q1. China's state administration just approved silver for strategic reserves. No specific number disclosed, but internal estimates suggest 50 million ounces annually. Do you see the problem yet? We're now at negative 185 million ounces before retail investment, before coins and bars, before ETF flows, before anything you or I might purchase. But here's where it becomes a nightmare scenario. COMEX registered inventories, the metal available for immediate delivery, dropped to 21.7 million ounces as of yesterday. Meanwhile, open interest on COMEX silver futures represents 638 million ounces of claims on metal. That's a ratio of 29 to 1, 29 paper claims for every 1 physical ounce. If even 4% of contract holders demand delivery, the exchange breaks. 4%. The last time this ratio exceeded 25 to 1 was March 2011. Silver went from $26 to $49 in 7 weeks. But here's the difference. In 2011, eligible inventories were at 112 million ounces. Today, 21.7 million, 1/5 the buffer, 5 times the fracture risk, 0 silver for solar panels that prevent climate catastrophe, 0 silver for 5G networks that power the digital economy, 0 silver for EV batteries that governments mandated, 0 silver for you. Coin dealers are reporting delays of 4 to 6 weeks for basic 1-ounce rounds. A major distributor in Texas told customers last week they're paying $3 over spot just to acquire inventory wholesale. They're then selling at $9 over spot retail because that's where physical demand clears. The market is bifurcating in real time. Meanwhile, institutional buyers are executing massive accumulation strategies. Samsung SDI, the battery division, signed a 3-year forward contract for 17 million ounces at locked prices. They saw the shortage coming and protected their supply chain. Toyota's March filing revealed they increased silver inventories by 23%, $8.4 million in raw metal stockpiling. The smart money isn't watching the paper price. They're hoarding the physical metal while it still exists at any premium. They know what's coming. They've run the same math. They understand that once the physical shortage becomes undeniable, premiums won't be $9. They'll be $40, $80, whatever clears the market when industries are bidding against each other for ounces that don't exist. This is the calculated trap. Banks smash the paper price, creating panic and capitulation among weak hands. Physical metal flows from retail to institutions at discounted real-world prices. Then, when physical shortage becomes mainstream news, the paper price explodes upward. But by then, you've already sold your metal to the very entities that orchestrated the crash. History doesn't repeat, but it rhymes with precision. And right now, it's rhyming with every commodity shortage that preceded explosive revaluations. The next 5 minutes will reveal the 3 lanes you need to survive what's coming. Miss this, and you'll be left holding paper promises while others hold ounces. This is your positioning blueprint before the physical premium exceeds 50%. Here's what's actually happening beneath the surface noise of price charts and mainstream financial media narratives. The disconnect between paper silver and physical silver just became unbridgeable. Paper silver, the futures contracts, the derivatives, the ETFs, can be created infinitely by typing numbers into computers. Physical silver requires mining 1 ton of ore to extract 3 ounces of metal. Those are not the same asset class anymore. Dumb money watches the paper price and makes emotional decisions. Smart money watches inventories, supply chains, and industrial offtake agreements. Dumb money buys strength and sells weakness. Smart money accumulates weakness and distributes into strength. Weakness becomes strength when the underlying fundamentals are screaming shortage. Your job is to understand which game is being played. The banks need you focused on price so you don't notice the physical drain. They need volatility so you capitulate holdings. They need panic so institutional buyers can acquire metal below replacement cost. What is replacement cost for silver? Here's the data they don't advertise. Primary silver mines, mines where silver is the main product, have all-in sustaining costs between $18 and $24 per ounce. But only 30% of silver comes from primary mines. 70% comes as a byproduct of copper, lead, and zinc mining. When silver was at $85, every byproduct ounce was generating massive margins for base metal miners. Now at $75, still incredibly profitable. But here's the trap. Byproduct supply is inelastic. It doesn't increase when silver prices rise because miners are extracting for copper, not silver. The silver just comes along for the ride. So where does new supply come from to meet exploding industrial demand? It doesn't. There is no cavalry, no massive silver deposits waiting to be developed. The last major primary silver mine discovery was in 2012, 14 years ago. Meanwhile, the institutional buyers, the entities that actually consume physical metal, are executing aggressively. LG Energy Solution locked in forward contracts for 12 million ounces. Jinko Solar secured 9 million ounces through 2027. These are companies that manufacture products requiring silver as an input. They're not speculating, they're ensuring survival. The manipulation proof is in the timing. That 11.3% smash happened at 2 a.m. when retail can't react efficiently. High-frequency trading algorithms executed 4,000 sell orders in 17 minutes. That's not organic selling. That's a calculated algorithmic attack designed to trigger stop losses and create cascading liquidations. And it worked perfectly. Paper hands sold, retail capitulated. The weak were shaken from positions they should have held through volatility. Meanwhile, coin shop owners from Florida to Oregon report they bought more inventory during that dip than any week in the previous 9 months. One dealer in Arizona said, "I've never seen this before. Price drops 11% and I have customers lined up paying $9 over spot." Normally when paper drops, physical demand drops. Not this time. This time they're treating it like Black Friday for metal. That's the signal. When physical buyers are aggressively accumulating during paper price crashes, the end game is approaching. When the premium explodes while the spot price drops, the market is breaking into two separate universes. The COMEX is becoming irrelevant for price discovery. The real price is what you pay at a coin shop, what Samsung pays for industrial silver, what sovereign wealth funds pay in private transactions. And those prices are rising while the paper charade continues. How long can this continue? Until it can't. Until a major industrial player demands delivery that cannot be satisfied. Until registered inventories hit zero. Until the exchange implements force majeure and settles in cash. And when that happens, not if, when, the revaluation will be violent, explosive, and non-negotiable. In the next section, I'm revealing my specific 3-lane strategy. This is the exact playbook that protected wealth through every supply crisis in modern history. Physical holders who follow this survive. Paper holders who ignore this become exit liquidity for institutions. If you're positioned in silver right now or considering entering, you need a 3-lane strategy that accounts for paper manipulation, physical shortage, and jurisdictional risks. Here's the framework. Your base position must be physical metal you control directly. Not ETFs, not mining stocks, not futures contracts. Ounces in your possession or allocated storage you can audit. Focus on weight accumulation, not collectible value. Generic 1-ounce rounds, 10-ounce bars, and government-minted bullion coins like American Eagles, Canadian Maples, or Austrian Philharmonics. The premium pain you're feeling now, that $9 over spot, is the cost of certainty in an uncertain supply environment. Do not make this mistake. Do not buy numismatic coins with high premiums based on rarity or condition. In a supply crisis, a graded MS-70 Silver Eagle doesn't trade for more than a generic round. You're buying elemental silver, not collectible status. Save the numismatic premiums for when supply normalizes. Consider weight tiers. If you're accumulating under $10,000, stick to 1-ounce coins for liquidity. Between $10,000 and $50,000, add 10-ounce and 1-kilogram bars to reduce premium per ounce. Above $50,000, consider 100-ounce bars if you're comfortable with lower liquidity on individual pieces. Storage matters critically now. If you're holding under 5,000 ounces, home storage with proper security is viable. Above that threshold, consider allocated vault storage with providers that allow physical audits. The key word is allocated. Your specific serial numbered bars, not pooled accounts. If you can't audit it, you don't own it. Physical is your foundation. Miners are your leverage play, but only if selected with surgical precision. The key criteria, unhedged production with low all-in sustaining costs. What does unhedged mean? The company sells silver at spot price, not locked into forward contracts that cap upside. Many miners hedge production by selling futures contracts to guarantee prices. This protects downside but eliminates upside when silver explodes. You want companies with zero hedging, full exposure to spot price appreciation. Look for all-in sustaining costs below $20 per ounce. When silver is at $75 and costs are $20, that's $55 in margin per ounce. When silver hits $150, that margin expands to $130. That's why mining equity can deliver 10-to-1 leverage on metal price moves. Avoid companies with high debt loads or production profiles dependent on byproduct credits. You want primary silver producers with strong balance sheets who can sustain operations even through volatility. Jurisdictional safety matters. Prefer mining operations in stable countries with established mining law. The warning: do not buy silver mining derivatives, leveraged ETFs, or options unless you have significant experience. These products decay, get liquidated during volatility, and often expire worthless even when the underlying thesis proves correct. Stick to equity ownership in actual producing companies. This lane is about risk management and timeline clarity. Silver's revaluation will not be linear or predictable in timing. You need positioning that survives volatility without forced liquidation. Never use leverage or margin to buy physical or miners. This is not a momentum trade. This is a supply crisis thesis that could take 6 months or 3 years to fully play out. Leverage gets liquidated during manipulated smashes, exactly like the one we just witnessed. Diversify custody jurisdiction for physical holdings if you're at scale. Some in domestic storage, some in offshore allocated vaults in stable jurisdictions like Switzerland or Singapore. This protects against any single nation policy risk, capital controls, windfall taxes, or confiscation scenarios that historically emerge during monetary crises. Accumulate now through volatility. Hold through the mania phase when silver is on mainstream news and your neighbor is asking how to buy. The temptation to sell at $120 will be intense. Remember, the thesis is industrial shortage meeting monetary demand. That doesn't resolve at 120. That resolves at prices that force demand destruction or substitution, which may be physically impossible for many applications. Imagine if you positioned in palladium at $490 in 2017 and sold at $700 because it felt like a big win. You would have missed the move to $3,000. The same psychology will plague silver holders. Accumulate physical, hold through mania, and only distribute when industrial shortage resolves or substitution becomes viable. Neither is imminent. The specific price target and timeline I'm about to share has historical precedent from 4 previous industrial metal shortage cycles. Pay close attention to these numbers and understand that supply-demand mathematics don't negotiate with hope or denial. The bank smash at $85 was not the end of silver's bull market. It was the final warning before physical shortage breaks the paper pricing mechanism entirely. This changes everything about how you position for the next 18 months. This is your last chance to accumulate physical silver before the shortage becomes mainstream news and premiums exceed 50% over spot. Before industrial buyers are publicly bidding against investment demand. Before coin dealers have nothing to sell at any price. Before the market realizes that 824 million ounces of production cannot satisfy 1.1 billion ounces of combined industrial, government, and investment demand. The entities that understand supply-demand mathematics have already positioned. Samsung secured 3-year forward contracts. Central banks are allocating reserves to silver for the first time in modern history. Sovereign wealth funds are establishing positions in 1,000-ounce bars through private transactions you'll never see reported. The window is closing with precision. Every week, another 2 million ounces drain from COMEX eligible inventories. Every month, another 47 million ounces get consumed by industries that have zero substitution options. Every quarter, the deficit grows while mine production remains flat. I predict silver will exceed $150 per ounce before Q4 2026. The mechanism will be a physical delivery crisis at either COMEX or LBMA that forces cash settlement of futures contracts, destroying confidence in paper pricing. When industrial buyers realize exchanges cannot deliver metal, the bid for physical will execute violently. The timeline acceleration depends on one trigger: a major manufacturer publicly announcing production delays due to silver procurement failures. The moment Tesla or Samsung or Jinko Solar tells investors they cannot secure sufficient silver for contracted production, that's the match hitting gasoline. But the mathematics guarantee the outcome regardless of timing. You cannot consume 943 million ounces industrially, add government buying, add investment demand, and supply the total with 824 million ounces of production. The equation doesn't balance. It resolves through price rationing. Prices rise until demand destruction occurs or substitution becomes viable. For solar panels, substitution is impossible. For 5G antennas, substitution is impossible. For EV battery dendrite prevention, substitution is impossible. So demand destruction must occur through price. How high must silver rise to destroy enough marginal demand to balance supply? Historical precedent from palladium, rhodium, and rare earth crises suggests 3 to 4 times current prices minimum. At $150, some marginal applications become uneconomical. Smart home devices might use copper. Low-efficiency solar panels might return to market. Budget EVs might accept higher failure rates. But the core industrial applications that define the energy transition, they pay whatever silver costs because the alternative is not building the infrastructure governments mandated. This is not about speculation. This is about understanding physical reality in a world drowning in paper abstractions. The banks can manipulate paper silver for months, maybe years, but they cannot manipulate chemistry. They cannot manipulate the periodic table. They cannot mine silver that doesn't exist in the ground. You are positioned in the single most undervalued strategic metal on Earth at the exact moment supply crisis becomes irreversible. While paper traders panic at 11% corrections, you're accumulating ounces that factories are desperately trying to secure. Diamond hands understand that volatility is the price of asymmetric opportunity. The enlightened few who hold physical through manufactured panic will be positioned for the revaluation event that occurs when reality overpowers manipulation. Physics always wins. Supply and demand always balance. The periodic table doesn't care about algorithms or futures contracts or central bank narratives. Silver is element 47, with properties no other metal possesses. Required for technologies humanity cannot abandon in quantities production cannot provide. Stay positioned through the volatility, hold through the manipulated smashes, trust the fundamentals when price action tries to shake your conviction. The entities orchestrating paper crashes are simultaneously hoarding physical metal. Follow their actions, not their price manipulation. The subscribe button below keeps you informed as this shortage unfolds. The inventory data updates weekly. The supply crisis escalates monthly. And the revaluation event approaches with mathematical certainty. This is not the top, this was the trap, and you just saw exactly how it works.